SpaceX lost $600 billion in 3 days. Here's what every investor and founder needs to know. 3 trading sessions, $600 billion gone. To put that in perspective, that's nearly 3 times the combined wealth of India's 2 richest men, Mukesh Ambani and Gautam Adani, erased in 72 hours. But here's the thing most people are getting completely wrong about this story. SpaceX's rockets are still flying. Starlink still has tens of millions of paying customers. The company has over $100 billion in cash in the bank. Nothing about the actual business changed. So what happened? And more importantly, what does it mean for you, whether you're an investor, a founder, or someone building something right now? That's what we're unpacking today. 3 practical lessons. No fluff. What actually happened? Let's run the tape. June 12, 2026. SpaceX goes public. Biggest IPO in history. They raised $75 billion at a $1.77 trillion valuation. Within 4 days, the stock is up 67%. Musk briefly becomes the world's first trillionaire. The company is worth more than Amazon and Microsoft. Then, 3 days later, it loses 23% of its value. $600 billion gone. What flipped the switch? SpaceX announced it was raising an additional $20 billion in debt, entering the bond market for the first time. This came just 10 days after the biggest equity raise in corporate history. And when investors cracked open the bond documents, here's what they found. The company had $29 billion in existing long-term debt. It was projected to have negative free cash flow, meaning spending more than it earns, all the way through 2029. Goldman Sachs put that deficit at negative $105 billion by that year. And one analyst projected SpaceX's AI spending alone could hit $666 billion by 2031. The stock had been trading at a price-to-sales ratio of 90x, meaning investors were paying $90 for every $1 the company made in revenue on a business that wasn't profitable. One venture capitalist said it plainly, SpaceX is 3 moonshots bundled into one company. They'll need at least 2 of them to succeed to justify a $2 trillion valuation. That's the setup. Now here are the 3 frameworks that explain exactly why this was predictable and what you should do with them. Lesson 1. Story is not the same as substance. 2 business professors at the University of Maryland spent years studying every major financial bubble, tulips in the 1600s, .com in the late 90s, crypto, and they found the same pattern every single time. They call it the narrative condition. A bubble forms when you have 3 things together. A technology nobody can fully prove or disprove yet, a huge and exciting story about the future, and a charismatic founder that people want to believe in. Sound familiar? SpaceX checked every box. The core business, rockets, Starlink, is real and profitable, but the IPO prospectus didn't sell that. It sold orbital AI compute, space-based AI data centers, a concept so new that no one can model it accurately, which also means no one can challenge it yet. The professors also pointed out something called the Tesla pattern. Every Musk company gets valued based on whichever story is hardest to disprove right now. Tesla was valued as a sports car company, then EVs, then energy storage, then robotics. The story keeps moving to the next frontier. SpaceX just did the same thing, moving from rockets to orbital AI, the practical playbook. For investors, when a company's valuation is built on a story that can't be measured yet, that's not a reason to buy. That's a reason to wait. Ask, what are they worth based on what they're actually doing right now, not what they might do in 5 years? For founders, your story absolutely matters. It gets you funding, attention, and talent. But the moment you have to go back to investors before the story pays off, they stop dreaming and start doing math. Build the story. But make sure the business can back it up on a reasonable timeline. Lesson 2. Your brain is working against you in a hot market. Nobel Prize-winning psychologist Daniel Kahneman spent his career studying how people make decisions under pressure. His finding, we have 2 modes of thinking. System 1 is fast, emotional, and instinctive. It's the part of your brain that sees everyone buying something and thinks, I need to get in before it's too late. System 2 is slow, analytical, and deliberate. It's the part that does actual math. In normal life, they check each other. In a hot IPO, System 1 wins in a landslide. Here's what that looked like in real time. Analysts at one of Israel's largest investment firms publicly warned before the crash that institutional investors, not retail traders, actual professionals managing billions, were buying SpaceX driven by FOMO and competitive pressure to not miss the trade. That's peer pressure dressed up in a suit. The result? Smart, experienced people bought a company losing $4.9 billion a year at 90 times its revenue, not because the math made sense, because they were afraid of being the one person who sat it out. Kahneman also identified something called regression to mean. Extreme swings, up or down, almost always correct back toward normal over time. The stock surged 67% in 4 days. A correction wasn't just possible, it was predictable. The practical playbook. For investors, before any major financial decision, ask yourself, am I doing System 2 thinking or am I reacting? A simple test. If the investment disappeared from the news tomorrow, would you still want it? If the answer is no, you're chasing a story, not buying a business. For founders, FOMO is one of the most powerful forces in sales and fundraising. The best operators know how to create it legitimately through scarcity, social proof, and momentum. But know when you're manufacturing it versus earning it. The market always finds out which one it is. Lesson 3. Price and value are not the same thing. Benjamin Graham wrote The Intelligent Investor in 1949. Warren Buffett has called it the best book on investing ever written. And one concept from that book explains what happened to SpaceX better than anything else written in the last week. Graham invented a character called Mr. Market. Imagine you own a business with a partner, and every single day that partner shows up at your door offering to buy your share of the business or sell you his at whatever price he's feeling that day. Some days he's wildly optimistic. Some days he's terrified. His mood swings are extreme. Graham's point, Mr. Market's mood is not your business's value. They are two completely different things. SpaceX's rockets did not get less reliable between June 16th and June 22nd. Starlink didn't lose customers. The engineering didn't change. What changed was how Mr. Market was feeling about the story. That's it. There was also a mechanical reason the swings were so extreme. Only 4 to 5% of SpaceX's total shares were available to trade publicly. That tiny float meant a relatively small number of buy or sell orders moved the price massively in either direction. The 67% surge was partly mechanical. So was the crash. The practical playbook. For investors, separate the business from the price. When a stock drops 23% in 3 days, ask one question before you do anything. Has the underlying business changed or has the market's mood changed? If it's the latter, that may be a buying opportunity. If the business itself has cracked, that's a different conversation entirely. For founders, you will face your own version of this. A bad press cycle, a competitor announcement, a slow month. The discipline is the same. Separate what the market is saying about you from what is actually true about your business. Don't let Mr. Market's mood become your company's strategy. The bigger picture plus. SpaceX's crash wasn't just about one company. It was the first real stress test of the AI valuation era. Every major tech company fell in those same 3 sessions. Alphabet, Nvidia, Tesla, AMD. The market is finally starting to ask a question it's been avoiding. When does AI spending actually produce returns? That question is going to find the next 2 to 3 years of business. The founders and investors who come out ahead won't be the ones who picked the right stock in the moment. They'll be the ones who understood the difference between a great story and a great business and knew how to tell which one they were looking at. So, here are your 3 takeaways. 1. Story creates valuation. Evidence sustains it. If you can't back up the story with real business performance on a reasonable timeline, the market will eventually recalibrate, painfully. 2. Your brain will lie to you in a hot market. The antidote is slow thinking. Do the math before you do anything else. 3. Price and value are not the same thing. Mr. Market's mood is not a verdict on your business. or on a stock you're evaluating. Don't let it be. $600 billion disappeared in 3 days. The rockets are still flying. The story isn't over, but the price of believing it just got very real. If this breakdown was useful, subscribe. The Executive Playbook covers the frameworks behind the biggest business stories every week. Books referenced are linked in the description. See you in the next one.